Hello guys. So as you probably have seen in the title, I've decided to do a bit of an exercise to screen all the public Spanish companies traded in the Madrid Stock Exchange. You probably realized by my accent, but I'm from Spain, so that's the reason I decided to start with Spain. And basically, I will try to repeat this exercise for other countries in the future, but yeah, let's just start for Spain. And I think it's relevant because it's usually the process I follow to find interesting companies um, from a top to bottom perspective, no? So yeah, let's just start. First of all, when it comes to the Spanish stock market, we have um, yeah, it's not the sum, obviously, it's the count. About 242 public companies traded in Spain. And the first step that I always want to do is to basically decide what's in my area of knowledge and what's not, right? And this is super important because you don't need to be an expert on everything, and there are industries that are more complicated to understand than others. Um, for me, some industries that maybe in the future I'll try to learn more about them, but right now I don't feel comfortable investing in them are banks and insurance companies, especially because um, understanding their value, I find it much more difficult than with other types of companies. No, so the first thing that we need to do when we look at a group of public companies, it's to decide which ones we don't have enough knowledge to invest in. And here, we can probably discard a big percentage of the companies that we're looking at. In this case, from 242 companies, as we said, I discarded about 60% or 145 companies that belong to all these different industries. So let's take a look. No? So for example, rates. I don't think it's usually a good investment in the long term because of how the tax is structured and the obligation they have to distribute dividends and so on. So I think it's difficult to have a compounding business in the long term using rates. So I automatically discard all rates. Um, then advertising agencies, I discard because it's basically what I define as a consulting business. So there is no product; you just offer services, and unless these services are unique, usually, at least for me, it's not a good, you know, long-term investment either. Um, Aerospace and defense, I discarded also. I don't know anything about this industry. Airlines, I discard also usually because one, I don't know much about the industry, and two, I think it's a difficult business, right? Um, then airports, yes, I think it's somehow easy to understand, and usually these are good businesses. Apparel manufacturing, so this is a clothing brand, also discarded because mainly because I think it's very difficult to have a long-term defensive mode in this industry, no? And similarly for apparel retail, also discarded. Then, as I said, anything related to financial markets, um, banks, insurance companies, I automatically discard. Then auto parts, this is more of a personal choice also because I think the automotive industry it's just undergoing a lot of changes, a lot of pressure from China and so on. So I automatically discard auto-related businesses. Then, as I said, all banks discarded because these are difficult companies to evaluate. All of these fall in. Then capital markets discarded, banks discarded, construction and engineering discarded because this is like it's a consulting, but instead of a typical consulting, it's like civil engineering consulting, but still consulting company. Um, these two are also consulting services companies, so I discarded them. Engineering and construction. Most of these are basically what I said before, right? So these are um, services firms that apply to tenders to build bridges, roads, and so on, mainly. And again, it's I don't think this is a good business in the long term, right? I don't see any defensive mode, maybe brand, but yeah, it's not something I feel comfortable in. So in the end, these are consulting companies in the engineering, civil engineering space. Financial conglomerates discarded. Insurance, as I mentioned, for the same reason as banks, discarded. Oil and gas. Actually, um, oil and gas, it's something I feel more comfortable in. Um, but I think, yeah, in the Spanish market, probably it's not. I will probably invest in US oil and gas stocks, not Spanish. So that's why I discarded it. Um, then Bale mining. I don't feel comfortable in mining either. This is again oil and gas, petroleum refining, and all of these are rates. So the Spanish market, it's characterized by two things, I would say. Um, One, it's real estate. Obviously, it's a big tourism hub, so there's a lot of real estate. There's a very high ratio of home ownership also, so there's a lot of real estate companies, a lot of um, hospitality industry companies, and also it has I would say, medium-sized pharma industry also Spain. So these are probably the two main industries that, when you think about Spain, you can think of. Pharma, real estate also. There's automotive industry, but it's not doing so well. In any case, going back to this, so all the rates discarded, and there's, as you can see, there's many of them. Um, Rental and leasing services, I also discarded. Um, and I think here probably actually this could be interesting, these two. Um, but yeah, again, I don't remember why, but I discarded these two. Probably I've looked into them individually, and for some reason I decided they were not interesting. Then solar energy and anything related to renewable energy, I automatically discard because I don't think it's a good business. And actually, the solar renewable energy industry, like solar panel manufacturing and distribution and so on, was super big in Spain until 1 or 2 years ago, when basically most companies went bankrupt because um, there was not so much demand. Government help for this kind of installation stopped, and then there was a lot of pressure from Chinese manufacturers at ridiculously low prices. So I just think it's not a good business. And obviously not there is not any competitive mode in these companies, no technology. They don't have any technology edge and so on. So discarded. Steel, also discarded all the steel companies because I don't know much about the space. And again, I think it's similar to any commodity business that I don't see like a long-term competitive mode in these companies. They depend on macro factors that are difficult to predict, very cyclical. Probably they are pressured from still Chinese manufacturers and so on. No, so I don't think it's a good business to invest in. Uranium, yes, actually we have super small uranium. How you say it in English? Deposit in Spain. I don't think it's even developed, but yeah, automatically discarded. And then all of these are utilities and renewable energy companies that I automatically discarded too. So as you can see from the 242 companies, public companies in Spain, we have discarded 60% of them. So this is, as I would say, what I would it would be the first step in when you're screening for companies, no? Trying to decide in which industries you feel comfortable investing in, either because of your own knowledge or because you don't think there are good business models there, no? But this is the first step, and then uh, the second filtering step that I always do is, and obviously with each consequent filtering step, you spend more time for each company, right? And in this case, basically, I've looked at just the website, a little bit of this description of the company, trying to understand a little bit of also like do a quick overview of the financial information of the company, and try to discard, because even if the industry classification was right, they were not interesting businesses, or there is no reliable information about them. So more of miscellaneous stuff, no? And in this case, we have discarded of the remaining uh, 97 companies that we had. So we already cut a lot in the previous filter. Of the remaining 97, we've discarded 27 in this second filtering step, and we are left with 70. No, but let's quickly look at the ones we discarded. No, so this is a specialty coffee company, Vanity Coffee. There is no reliable information. Market cap of 12 million. Many reasons to discard it. Then there are two companies that were inactive, actually, so not they were in the initial screening filter, but they are not trading anymore, so discarded. Then another renewable energy company that was labeled as electric services, discarded. Another company with no reliable financial information, discarded. Um, then a football team classified as entertainment, which makes sense, but discarded. I'm not interested in investing in football teams. Um, Pescanova, it's basically a fishing company. There is no reliable financial information in the stock screener that I use. Probably I could find this because it's not, well, actually it's quite small now, 8.8 million, so super low market cap, reason to discard also. Um, and so on, no? So no reliable information. Then some other IT consulting companies that probably some of them are doing well, but it's not something I want to invest in the long term, but because of the underlying business model. So discarded all of these that were labeled in other industries, some more with more reliable information, some commodities companies that were labeled as metal fabrication, and so on. Then some companies that are actually based in Brazil but traded here, discarded, and so on. No, but basically it was looking at for which of these companies we have reliable financial information, and this is usually basically tied to market cap. No, so many of these companies have a very small market cap, and the quality of the reporting it's very low. Um, so these I automatically discard because difficult to evaluate a company if you don't have enough financial information. And then also looking at more closely at, okay, this company is classified in software application as an industry, but in reality it's an IT consulting company. No, so it's basically cleaning a bit the previous filter manually. And then we move to the third filtering step. No, and this is where things begin to start to become interesting. Um, and here I added some new filtering steps. No, so filtering fields, and they both deal with the same metric, which is return on assets. Um, and return of assets, it's not all assets, and you probably have seen this in other videos that I've done. I think there's one about the pharma industry that I spoke a bit about this, but um, um, return on tangible assets, it's a very good metric to evaluate the competitive mode of a certain company, especially when you're comparing, obviously, companies within the same industry. No, so some industries, tend to have overall higher return on assets than other industries. Um, but comparing return on tangible assets for companies in the same industry, um, it's a very good way to find companies with competitive mode, with a strong competitive mode. And in this case, I use the 5-year average return on tangible assets and also the 5-year um, um, growth of return on tangible assets. No? And the average just gives you an idea of the last 5 years, obviously. And the growth I use because, and this is more of more of a theory that I have, no? But and we could also look at 10-year growth on return of assets, which I have actually in the database tab that it's feeding all of this. That basically, if we have a positive 10-year growth on return of tangible assets, it means that the company is actually building or strengthening their competitive mode. Because it's constantly improving the return on their tangible assets, no? Um, and basically, this um, this is a good way to find for companies with a competitive mode, no? That's the idea. And I basically ordered all the remaining companies that we had, which were, let me quickly check, but 70 companies by the average return on assets. And this is just makes it easier to start with the most interesting companies. Um, and as you can see, as we go down to lower return on assets, we discarded some companies for different reasons that we will look into, no? And in this case, again, from 70, we discarded almost 40%, and we keep 43 companies for the next filter. So as you can see, the first three we discarded for non reliable information. This actually should have been discarded in the previous filter, right? But yeah, I don't know. I only found about this later. Then the other one, and this is the one with a higher return on tangible assets, so it's super high. It's basically one of these biometric verification software tools. And software companies usually have very high return on tangible assets, no? Because they don't have tangible assets. That's the thing. And probably, we could add some additional metrics to see how to evaluate software companies, no? Which I'm not super knowledgeable about, but maybe this is an idea for another video. Anyways, this one is discarded because one of the problems with software companies, and especially all these SaaS businesses, it's competition, right? So the competitive mode. And the long-term defensibility of the solution, because also technology as a space, it's an industry that changes super fast, right? So one day to the other, Google can launch a new feature that basically makes your company obsolete. So in this sense, I'm very, very wary. Wary is the word? Yeah, and just sometimes very wary of investing in software companies. And in this case, also the company had inconsistent profits, so automatically discarded. Then there was some biotechnology companies that I also discarded because actually this is not true. The ROI is quite high, but it's just that the company had very inconsistent profits because, yeah, biotechnology companies depends on patents, expiration dates, new drugs coming into the market, and so on. But I discarded that one. Then I discarded this because also very inconsistent profit, and you want companies that have reliable revenue over the years, so that do not have huge fluctuations in revenue and therefore in profits, because this means that the company has strong foundations. Otherwise, in this case, probably I can already tell you that this is it's an olive oil producing company, and it's basically a commodity company in a way, because their profits are directly tied to the wholesale price of olive oil, and there is no competitive mode right there. So um, discarded by inconsistent profit, but also they have inconsistent profit because they don't have competitive mode. Then these two have very low return on tangible assets. Um, then also low growth, low return on tangible assets. Um, yeah, and so on. So many of these, it's because the return on tangible assets is very low. The ones I decide to keep, it's because the growth actually of the return on tangible assets, it's good. No? So in this case, return on tangible assets, it's almost 12%, but the growth in the last 5 years, it's 25%. So, maybe right now they don't have a super strong mode, um, but it's growing. Somehow they are generating more income on these same assets. Here it's similar, and I know this company very well, Aina, and I will discard it in the next filter actually, but it's not a bad company. Um, and then this one is also growing 5%, which it's good. I decided to keep. And here I kept some utility companies that had very low current return on assets, but actually they were growing, 10%, 15%, and so on, which it's quite nice. Here similar, also this is one, it's also growing return on assets quite nicely. This one, it's growing nicely, but it's at 1%, so it's super low. And then the rest had negative return. And from the ones that had negative return, I decided to keep this one, because I think it's an interesting one, I know personally. So this is more of a no personal pick that I decided to keep, and rather than, if you look at the metrics, you would not touch this company probably. Um, so that's it. We discarded all the ones with unreliable profits and low return on assets, but decided to keep the ones with high return on assets and not so good return of assets, but growing, with positive growth on the return of assets. So with in total 43 companies, and just to quickly make a point here, no? So if we look at one of these companies, no, for example, Squirrel Media, um, maybe this is not the best one. Let's see, Amadeus, no? So this is basically a software company, but it means that they are generating in operating income, almost generating 2 times in operating income what they have in tangible assets, no? So this means that these companies with high return on tangible assets have some kind of barrier, because otherwise, you would buy the equivalent, no? You would buy the same assets that they have, and suddenly start generating 2 times what those assets costed you per year, no? So everyone would do it, no? So why is not everyone doing that? Because they have something that it's not so easy to copy as just buying what their assets have. No, in this case, their assets probably are a few offices, they're tangible assets. So from their offices, they're generating 2 times the operating income. Why? No, because they have something that it's not measured there, and in software companies, sometimes it's more difficult to measure, but in other industries, it's easier, as you will see in the next step. Okay, so the fourth filtering step, it's quite manual already. We only have 43 companies left, and we discard 13 of them. So we keep 30 for the final filtering step. And basically here, what we are doing is we're adding return on equity, dividends, dividend years, not which is basically it's many ways to measure this, but it's just for me it's more subjective. It's looking at how reliable have they been with their dividends, no? Because if a company starts paying dividends, um, if the management is good and their sources of income are also good, they usually at least keep the dividend at the same level or increase it consequentially, no, throughout the years. But if suddenly you pay a dividend and then the next 5 years you don't pay anything, and then in the 6 years you pay half of what you paid in the first year, and so on, no? So I think inconsistent dividend track records, it's a red flag. And I think it's better to have a company that has never paid dividends and has used cash wisely for other reasons than a company that has paid dividends very inconsistently. Um, but also having a company that has always constantly increased the amount of dividends year over year, no? For many years, and never miss the dividend payment. This also is a very good green flag, no? That shows that business has a very strong foundation and has been able to keep up with inflation, constantly increasing dividends, never missing a payment. So good cash flow management by management, no? And so on. But let's look at the companies, no? So the first one passed the filter, no comments. Second one, yeah, so this is interesting company, but it's super small. It's still 7 million market cap. Um, and I don't feel comfortable investing in a company that is so small and also that doesn't have enough track record. But I think the business model that they are building, it's potentially interesting. So if someone wants to look into it, feel free to do it. But it just, I don't feel comfortable with the amount of information we have so far. Um, yeah, this other one, it's the one I mentioned in the previous filter at the end. So negative return on assets, negative growth on return of assets, but um, and I think the problem here is more of a competitive mode thing. But I think the execution of this company, and again, this is a company I know pretty well, um, but otherwise this is very difficult to assess. But I think the execution of this company will be good. So even though um, there is not super clear defensible mode, I think they will do well and probably get acquired by one of the big players in the next 5 to 10 years. It's a basically telecommunications company, so you know mobile lines and data and so on. Um, this one discarded because there is not enough track record. Um, this one, yeah, so it's a luxury um, company. It's the equivalent in Spain to LVMH, no? So Louis Vuitton and all of this. It's just an aggregator of luxury brands. I think return on assets super high because they have huge profit on these products, and also return on equity is super high. I just don't like the long-term competitive mode. Like I feel um, clothing brands um, are difficult to evaluate in terms of long-term competitive mode, and the rate of change I feel it's quite high. So yeah, and also super competitive space. Like many companies are doing the same. Like I don't know how much they're paying to acquire all these companies. Like potentially a good investment. I just don't like it personally. Um, Naturhaus, yeah, this is a franchise model, which is usually very good. Um, but the underlying business, like it's basically a franchise model of for food supplement stores, no? And yeah, super high return on assets, like super high ROI. Just I don't like it. Personal choice. Um, Amadeus. So this is the software company we were discussing before. And I think this is actually it's a good company. I discarded it because it's a software company that has good modes, which it's difficult to find, and they are an aggregator of travel information, like to summarize it in a very simple way, and they have network effects. No? So they have so many connections and data sources interconnected that it's very difficult to displace them. But at the same time, I feel uh, Google could, launch an API or something and replace the full business at some point. So yeah, I just maybe I don't understand enough about the industry, but about how this travel information, uh, yeah, business works. But yeah, it's a no for me. It's personal opinion, I guess. Then Coca-Cola, this is basically the bottling company in Spain and probably other countries in Europe for Coca-Cola in Spain. And I discarded it because I think it was trading actually in the London Stock Exchange also. So I don't know why it was in my initial filtering step. In any case, the business is good, but if it's not as good as the actual Coke business, no, which is you just sell the formula basically to all these bottling companies across the world, and they do all the work on operational expenses. So discarded. And then what else? This one I kept. This one I discarded because it's an e-signature software, and they have some partnerships with government agencies and so on. So there is a bit of moat there, but I don't think there is a long-term moat when you can do this now through Google and a thousand other services. So discarded. Grifols. This is also an interesting company. Like many of these companies, I could do a full video on like on the history of the company and why I don't like them. In this case, I think it's a combination of just a track record of how they treated shareholders. It's not good. The management has done a lot of shady things because it's a family business, and they did some transactions between the main company and some the family office of the family owning the business, like some very shady stuff. They put a lot of debt on the company. They're using the company, like you get the feeling they're using the company as their own piggy bank, right? Um, and the underlying business is good, but also which is plasma donation. Basically, they have a monopoly on plasma donation centers. But some of the diseases that needs to be treated with one of the plasma derivatives are having other better therapeutic options now that are being launched into the market. So, for example, for hemophilia, which you get pl platelet transfusions, which are derived from plasma that these guys create. Um, Now you have a gene therapy, no? Many gene therapy options for hemophilia, other treatment options like, yeah, too many red flags, I would say. Then this one, unclear mode. This one, bad track record with investors also. Unclear mode. This one has super high return on tangible assets, but I don't see the mode. It's basically an online travel. No, it's not an online travel agency. It's like it's not exactly that, but it's like a travel tech company, eDreams. It's quite famous actually. I don't see the mode. And then this one, it's a casino company, basically probably super profitable, but have some ethical concerns with that, and also um, they just I think this year went public in the Madrid Stock Exchange. So um, yeah, I don't see enough track record. So let's jump to the to the next filter and the last one, because we're losing a lot of time commenting individual cases. And here basically I made a qualitative assessment based on the metrics that we gathered in the previous filter for all the selected companies. And also I calculated the enterprise value to free cash flow of each one of these companies, which is one of my favorite valuation metrics, which it basically tells you how much based on the cash and debt on balance of the company and the free cash flow that it generates, how many years you need to pay for the company. No, I think it's a better metric than P/E ratio, because P/E ratio you don't take into account cash and debt of the company in the balance, which I think it's very relevant. And then I also calculated the intrinsic value using a free cash flow model, 10% discount rate, and so on, and compare that to the current price of the stock. And as you can see, there are not that many good options. No, so we have revenue growth, we have return on assets, we have 5-year return on equity, we have dividend quality, which, as you can see here in the legend, it's basically how good their dividend track record is. Then also a qualitative metric on what's the strength of the moat of these companies from a pure personal perspective. And yeah, let's look at the company. So A3 Media, this is basically, they own the biggest news channel in Spain. They have some other news channels. I think it's super good business. Actually, the stock of this company went up substantially this year already, since January. So it was much cheaper than than it's now, and still actually below intrinsic value. The only thing I don't like about this company is that I don't like totally the cash flow management by the management of the company, in the sense that the dividend quality has not like, they don't have a super good dividend track record. So I think this is for me a wait and see situation, because they are not growing revenues that fast. So in this case, in companies that have good businesses, they're generating cash, but they are not, their underlying business, it's not growing a lot. Actually, the 5-year revenue growth is negative. You want to see that they are returning money to shareholders, no? And I haven't seen this in this case yet. So it's a watch and see. Scurril Media, it's also like a news. They own a few channels and basically a media production company. I don't know them super well, but revenue growth super good, return on equity not bad, return on assets obviously super good for a company of this type. It's a quite small company, so the market cap it's not super high. They are still not generating free cash flow, I think, or I did not calculate it. In any case, I think this is a wait and see situation also. Like, they are growing very fast, but I don't know how strong their moat is. But I really like their report. I looked at one of their more recent corporate reports. So wait and see. Not the first option, but maybe for the future. Media for Europe. So this similar as the two above, also news channel. It's similar case to A3 Media, but less profitable, but much cheaper. So it's 2.9 times EV free cash flow. Intrinsic value, as you can see, is much higher than the current price. Again, the main problem here is that this is also family business owned. Even though they are generating a shit ton of cash, their dividend track record, it's shit. It's very bad. So I want to see that they take shareholders more seriously before investing, because this could be a typical value trap, no? So it looks very cheap, but it's because management doesn't give a damn about investors. Prosegur Cash, good business overall, to be honest. I think the reason for me to discard this one would be basically their dividend track record. It's not super good. It's not cheap compared to how much they are growing. But probably could do good, but not worth the risk for me. Then we have a bunch of, actually just one pharma company here, FAES. Just it's too expensive for me. The number one reason to discard this one. Clínica Baviera, it's priced perfectly actually. Intrinsic value versus current price. Um, it's a I think I don't know if it's a franchise model, but it's basically a chain of health clinics in Spain, and it's well known. I don't think it's a bad business. I just don't know what's the long-term competitive mode besides branding. Like a lot of people know this, but will will people still know about this 20 years from now? Like competition from other clinics offering cheaper prices or better service. Like many ways management can fuck this up. Then Asokian, this company I like quite a lot, and would be one of my top picks. Basically, it's they do payment systems and security systems, and then they're also involved in in coffee vending machines, I think, which is a lot of different stuff, but somehow there are synergies actually between all these different business, and all the businesses are profitable, quite profitable, do not require a lot of capital. Most of them are growing, only one of them it's stagnating. Um, so it's actually I like the business. Dividend quality has been average or good, I would say, maybe. So not bad. And it's not super expensive. So this would be one of my set final picks. Promotora Informaciones, they own a newspaper in Spain, basically. No dividend track record. The moat, I think, is strong because everyone knows this newspaper. I just think that it's expensive for how much they're growing. And again, with this type of companies that they are not growing a lot, I want to see a track record of returning money to shareholders either through dividends or stock buybacks. Then Fluidra, it's similar to it's a pool company, so they do all the different uh, swimming pool. I mean, how to say tools and basically all the how you say it in English, items you need to take care of the pool, like maintenance stuff and so on. No? So all the machines, products, and so on. I think the business is good because it's quite recurring. No, once you have a pool, you tend to take care of it. The thing that puts me off here for now is that dividend quality has been bad. I think mode is strong and it's super expensive. They have a lot of debt and so on. So that's the reason I would discard it. Then Laboratories Farmacéutico Rovi would discard because it's actually too expensive and dividend quality has been bad. Green Ecologic, I think it's too early. Like it's still not super big company, I think, in terms of market cap, and it seems like it's a waste management company, and they are aggregating like different waste management companies in Spain, which is tends to be a good business in the long term. Um, I just, yeah, I want to see more of this company before investing, but the pricing looks right. There are no they don't have a dividend track record, but as I said, it's better to not have any than to have a bad one. And they are growing 10% per year, so it's good. Compañía de seguridad, it's also good. It's basically they own Prosegur Cash, so it's like cash moving business from banks to businesses and so on, which it's going away probably with credit cards, but will take much longer than we think, as always. And what I like is they are launching new business lines. One of them is like security alarms, which I think is a very good business. And overall, I think their revenue growth will improve. The return on assets is good. Return on equity it's not bad. They have a good dividend track record, and I think some of their business lines, especially the cash one, even if will not hold in the long term, has very strong business mode. defensive mode. The only problem is that it's expensive, no? So if it was cheaper, probably it would be a buy. Then next one, expensive. Um, Next one checks all the marks, but to be honest, it's priced correctly now. Similar for this one. This one is actually expensive. Vidrala, I like a lot. It's a super strong mode company. It's growing 10% per year, good return on equity, not bad return on assets. I think the only problem is it's a capital intensive business, but in the end, it's that's their mode. That it's so expensive to copy what they have that it's not worth it. And yeah, the problem is that they are overpriced now, so that's the reason to discard. Then Sequoia Comunicación, yes, basically bad dividend track record, like doesn't inspire me confidence. This other one, it's overpriced, or priced correctly, overpriced, or priced correctly, overpriced, or priced correctly. Logista, really good. I think it has a strong mode. It's a distribution of tobacco and pharmaceuticals, so it's regulated distribution businesses. Return on equity has been super high. Return on assets, it's not amazing, but it's a distribution company, so you would expect that it's not super high. And it's quite cheap actually now, so I think this would be a buy. This would be a buy for me, to be honest. And then all of these are too expensive to look at. And this one, it's the other one, the telecommunications company that I think will do good execution, but it's a wait and see also for me, no? So in the end, from the 242 companies that we started with, um, there is 5 that I would probably invest in right now. So and only these 2 are priced at the point where I would invest now. So I would probably invest in either Logista and Asokian now. And then if they get cheaper, I would invest in Vidrala or Prosegur or Fluidra. If also Fluidra, especially, I want to see that they treat better shareholders. But this would be the idea. Then Squirrel Media. Yeah, watch list probably. Robot, yes, I agree. Sirsa, to be honest, no. Would be Parlem Telecom, which is a telecommunications company, and then Squirrel Media, which I think is also going to do good. So this would be the watch list. Yeah, I don't think I'm missing anything. That's it. Thank you for your time, guys. I hope this was useful. Probably I rushed because this is an exercise that takes a few hours to do in reality. So probably, yeah, I rushed it a bit and I talked too fast. But yeah, if you have any question, just put it in the comments.